Hello, I'm Greg Bonnell. Welcome to Market Call Tonight. Our guest, David Burrows, President and Chief Investment Strategist at Barometer Capital Management. Wants to take your calls and emails and tweets on North American large cap. So here's how. Call us toll free, 1-855-326-6266. Send an email to marketcall@bnn.ca, or you can tweet us at Market Call. Welcome back to the program, David. Always a pleasure to have you here.
Greg, I'm happy to be here.
So we're I don't want to say we're into the spring of 2018 just yet because the weather is betraying us across most of the country, but we're a couple months into the trade, and it has been a wild 2018 so far. We've had our corrections, we've had our pullbacks. How do you view the market now that we can move into the next part of the year?
So we're very constructive. The last 2 years we had 16 and 17, of course, were exceedingly low volatility years. And they're very similar to the rally that came after the correction in 1984 in the early part of that structural bull market. Very similar to the bull market that we had after the first correction in the early 1950s. And in both of those cases, when you got to year 3, you had more volatility. In both cases, you had like a punch in the face right off the bat.
A lot of people felt that this year, yeah.
And in both cases, big up years in the third year. And it would be exceedingly rare for the first correction to be the one that breaks the back of a bull market. What happens is you get a shakeout rally that reminds everybody that it can sting and it can leave a mark, but then things turn and run higher. It's interesting to know that 6 of the 10 best days in the market in the last 20 years came within 2 weeks of the 10 worst days. So I think that this was a shakeout rally. We held very nicely at the moving averages. Many of the leadership themes that were leading coming into the correction held long-term trend, definitely pulled back, and are now rallying off that. And the sectors that are leading since the lows a couple of weeks ago are all economically sensitive sectors. These are not sectors that rally if we think we're headed into an economic slowdown or a recession. So I think it reset sentiment, but ultimately I think it gave people an opportunity then and now to be buyers. And I think that we likely have 4 to 6 months in front of us of really constructive markets.
4 to 6 months. I know a lot of the cautious crowd are taking a look at the yield curve, the spreads between the 2s and the 10s. They're getting worried about that spread narrowing. I mean, we're not even flat and we're far away from inverted, but they are concerned.
Right, and I smile when I hear that because, if you take a look at all of the last sort of 10 recessions, you were like 21, 22 months before the market ultimately made a high once the yield curve got flat. So we're not flat. And the reason that the yield curve is flatter is the 2-year yield has been moving higher nicely. That's not a sign of things slowing down. So I think that, we still have significant running room in front of us. And I think probably some pretty constructive conditions. And I do smile when I hear that hedge funds got the most short the NASDAQ in the last 8 years in this pullback. And I think it's rallying in their faces.
What do you think in terms of geography? The Canadian market, I mean, we had a decent day today. When I look year to date, we're not in a positive place.
Right.
The U.S. markets are back there. Is there opportunity in Canada? Or are there better places to put your money?
So we have, in general, avoided Canada over the last few years. The Canadian market, just from a price perspective, is not far from where we were in 2007. However, in the last couple of weeks, you have seen some strength in energy. And that was an elusive part of the market over the last couple of years. We were seeing strength in basic materials coming into the correction, and they have resumed their strength. So things like aluminum and nickel and steel. So it's possible that we could see a catch-up trade in energy. I know we've put on an energy position for the first time in a couple of years. And there's some companies behaving really well technically, and some companies that actually got a lot better during the trough when people really weren't looking. So the Canadian market perhaps could get a little bit of legs here in the third year of a bull market. Canada can play some catch up, and I think you could see some strength. The problem is you can invest in great energy companies in the U.S. without the political hassles we have in Canada right now. So, that remains to be seen. The breadth or the overall health of the Canadian market doesn't match up to what we see in the U.S., but it's getting a little better.
All right, a little bit better. We'll take a little better. We'll be back with David Burrows, President and Chief Investment Strategist at Barometer Capital Management. He's answering your questions about North American large caps. So give us a call, toll free, 1-855-326-6266.